Hey there, if you're confused on why stock prices move a certain way after an earnings release, or you want to get an edge in your investing, one of the ways is anticipating how stock prices move after earnings releases. So in this video, I'm going to show you how I analyzed earnings releases when I was an equity research analyst on Wall Street. You can do it in about 5 to 10 minutes. By the end of this video, you'll be able to anticipate how a stock will move post its earnings release. I'm Henry Chien. I've spent 10 years on Wall Street as an equity research analyst, and now I teach investors how to make money in stocks using Wall Street methods. If you want to learn more about the fundamental framework, there's a link in the description below. Basic overview to start is that every quarter a company will release its earnings results. And sometimes they also disclose guidance. Guidance means management's estimates for the company's results. The company reports this new information, both the earnings and the guidance, then the market processes it, and then the stock's valuation changes. Now, the market has specific expectations for the company, and that's reflected in the current stock price. It can mean Wall Street's estimates for the company's earnings. That's one way to look at expectations. Another way are indicators that suggest how investors or traders are positioned in the stock, meaning are they long, meaning they're holding the stock, or are they short, meaning they're selling the stock. When the new information hits the tape, the market gets that information and then the expectations change. And that's how stock prices change. So we're going to start with expectations, and I'm going to show you specifically what to look at to be able to anticipate how a stock price will move post that earnings release. So now for our prep, starting with what are the estimates? So if you go on Coifin or Ticker, you can start to get detailed analyst estimates. Well, I have Paylocity. We can see the quarterly estimates over here. It's really nicely laid out because we can see the different metrics for each of the quarters. So you want to start off with the high level stuff, things like revenues, profits, so gross profit and EBITDA, and any cost items if possible. I'm going to show you in a different report where I got that, as well as earnings per share. We want to be able to pick out the key estimates so that we can compare it with the earnings release. All right, so for this example, for Paylocity, I've actually pulled out an equity research report. So if you go onto your brokerage account, you can usually download their broker research. So for example, if you're in Bank of America, you can probably get Bank of America, Merrill Lynch research, same thing with Credit Suisse or Goldman Sachs and so forth. You can pull out their equity research report if they cover the company. So here I have Paylocity from Barclays. I'm actually going to pull out the 2Q24 estimates from here so that we can use that to compare with Paylocity's earnings estimates. So I'm taking the data from here and putting it into the spreadsheet that we're using. So first thing, we want to list out the key line items like I have over here. And we want to set it up so we can calculate the difference. So I put in the analyst estimates from the research report I showed you into this column here. And of course, I've set it up so that it can compare the difference. So we're looking at the analyst estimate and comparing it with the actuals. And I've also set up a comments line here, which can very quickly tell us whether or not it's better or worse than expected. It's very simple. It just takes that difference and using these rules over here will tell us whether it's better than expected or worse than expected just based off the percentage difference. So now let's go into the analysis. Let's compare the 2Q24 results with the expectations. We want to compare the difference between the analyst estimates versus the actuals reported by the company. So the company reported $1.49, analyst estimates is $1.33. So that's a 12% difference. And so that's much better than expected. If we look at revenues, Paylocity reported 326. Analyst estimates were 332. So it's slightly worse than expected, about a 2% difference. We can also look at gross profit. So that's 237 versus 243. Analyst estimates is also slightly worse than expected, a little over 2% difference. But if we go down to the operating income, they reported about 93 million operating income. It's actually much better than expected. The analyst estimate was about 83, so it's almost 12% higher. If you look at the general and administrative expense here, you can see that that actually declined close to 4%, and that's a lot lower than the 37 million that the analysts expected. So it's much better than expected. And you can also see down here in the bottom that margins expanded. The operating margin expanded from 23 to 28. The analyst was expecting 25%, so it's much better than expected. So even though revenues weren't as good as the analyst was expecting, because they had cut their costs a lot more than the analysts expected, that's how they were able to achieve a higher than expected operating income. as well as earnings per share. So, what this means as an investor in the company, so it's telling us that sales are coming in lower than expected. Of course, I should be worried, but it does seem like they can also reduce costs to keep up their profits, which is great for me as an investor because that means they can continue to grow their earnings, which improves the stock value. The earnings, was this a beat or a miss? Well, because earnings per share were much better than expected, I'm going to say that's a strong beat. And then what is the source of the earnings beat or miss? Well, that was margins because margins were a lot better than expected. Now, the source of the beat is important because it tells me how the company was able to achieve their earnings beat or miss. If it's based on operations, so things like sales or margins, those are the kinds of things that can continue because they reflect what's going on in the actual business. But if it's something non operational, something like taxes or share count or just other items in the income statement, that might just be one time, so they won't continue. Well, that just tells you that the earnings beat or miss might not continue in the future. So that's the earnings release. Now let's move on to the guidance page to analyze management's guidance. So Paylocity provides annual guidance every quarter, and guidance is important because it sets the estimates for the future. If you're looking to estimate the company's future earnings, management of the company has the best visibility of the company's earnings, right? Because they're the ones operating the business, they see the actual financials. So their estimate, management estimates, tends to determine what investors expect for the company. On the right, I've pulled the prior fiscal 2024 guidance, and they provide guidance for revenues and adjusted EBITDA. And on the left, I've pulled out the updated fiscal 2024 guidance as well for revenues and adjusted EBITDA. So over here on column F, we can look at the change to guidance. You can see that they've lowered their guidance, both for revenues and adjusted EBITDA. So on the midpoint, they both come down about 1%. In the bottom over here, I've also pulled in the prior consensus estimates for both revenues and adjusted EBITDA. So these are the estimates before the earnings release. Now, this is called consensus because it's the consensus of all the different analysts that cover the stock. In the same way here, you can go to Koifin or Ticker to check out the analyst estimates. I already showed you, so I won't do it again. Now, the analysis. So what we want to look for is what is the change in guidance? If guidance is lowered, it means the business is performing worse than expected. If guidance is raised, it means the business is performing better than expected. Pretty simple. So what is the change in guidance? Revenues were lowered at both the high end and the low end. You can see that the current revenue guidance is both lower than the prior one, both on the high end and the low end. For the adjusted EBITDA guidance, it looks like it's just the high end of adjusted EBITDA guidance was lower. So what this means is business sales seem to be slower than expected. So that's why guidance for sales is lowered for both high end and the low end. But it looks like they can maintain their profits, just not as much. And so that's why earnings or the adjusted EBITDA guidance is lowered at the high end because there's less sales. But because the low end is maintained, it seems like they can probably maintain their earnings target. Since the guidance will determine the future estimates, we want to look at what the change will be to estimates to get to that new guidance target. So you can see that this is the prior consensus estimate. If it goes down to the current revenue guidance, I've calculated a change here, implies about a 2% revenue estimate decline. Adjusted EBITDA, I've done the same, but it looks like it's 476 to 477. It just means adjusted EBITDA will come down just a slight tad at about 0.3%. I'm going to focus on the earnings estimate or the earnings guidance. And so the expected change to earnings estimates will just be the change to adjusted EBITDA. Now let's look at positioning. These indicators give us a general sense of what investors are expecting from the company. If they're feeling really positive, it means they're bullish. If they're feeling really negative, that's what we usually call as bearish. And if it's just no real direction, it's just considered neutral. And the reason why we do this is because if the company's results are a lot different than what investors are expecting, it might cause investors and traders to change their positions. They might go from bearish to bullish or vice versa. And that's why we want to understand the positioning in the stock price so we can be prepared for any reversals because that will show up in the stock price. Now, there's a couple indicators that we can use. I've listed them over here, but I'm going to switch over to Koifin so you can see them visually. Starting with short interest. So what short interest is, it represents the percentage of shares that are sold short, meaning investors have borrowed shares and sold them because they expect the stock to decline. So a height short interest basically means that investors are bearish. See, when it comes down, then it means investors are bullish. The other metric that we can use is valuation. So here we can use the NTM price to earnings ratio. So the next 12 months earnings per share relative to the price. When valuations rise, it means investors are more bullish. When valuations decline, investors are more bearish. So when we're looking at Paylocity here with this chart, you can see over the past 1 year, valuations have come down. So that just suggests that investors are a lot more bearish on the stock right now. Another indicator that we can use is the price trend. When investors are more bullish, obviously price comes up. When investors are more bearish, price comes down. Now, the important thing here is to compare the price trend relative to a benchmark. Since Paylocity is a software company, here on this chart, I've pulled up a relative strength chart to compare the performance of Paylocity's stock relative to the NASDAQ index, because that's usually compared with software companies. Can see that Paylocity, if we switch to a 1 year view, Paylocity has underperformed, meaning the price has had a much lower performance or even negative performance relative to its benchmark, the NASDAQ. Now, we want to compare the valuation of Paylocity stock relative to its peers. That's what the comps are called. Because if the valuation is higher versus its comps, it means that investors are more bullish on Paylocity relative to its peers. And if it's lower, investors are more bearish on Paylocity versus its peers. And we compare it with the group because sometimes investors might get more bullish or bearish on the entire group. So in order to hone in on the specific stock, in this case, Paylocity, and to check whether investors are more bullish or bearish on this company versus the group, we want to look at the multiple of Paylocity relative to its peers. So you can see the blue line here is the multiple for Paylocity, and you can see that it's come down relative to the group, but it's also much lower overall. Now let's jump back into the analysis. I'm back in the spreadsheet. For both short interest and valuation, these positioning indicators, what I've done is I've compared the current value relative to the 1 year mean or the average so that we can see the change relative to the year to indicate either bearishness or bullishness. Now you can see that the short interest decline, it means that there's actually less shares as a percentage being shorted. At the same time, the valuation decline means that a lot of investors have already sold the stock. So that could indicate that a lot of investors or traders have already sold short, meaning they borrowed shares to sell in anticipation of the price decline. And since the price has declined already, you can see that's why the valuation has come down. Maybe some investors have already closed their positions, and that's why the short interest has come down a little bit. Now we can look at the price trend. Now that is really significant underperformance. The price of Paylocity is down 24% over that 1 year period relative to the QQQ, the NASDAQ, that's up 42%. So that negative 66 relative performance confirms obviously the price has come down a ton. Now moving to the valuation, I pulled out the current next 12 months price to earnings ratio as of the 1st of February in 2024. So these are the valuations before the earnings release. Now you can see that there's a wide range of valuations for these different companies. Paylocity is basically at the very lowest in the group. Clearly, investors are bearish on Paylocity relative to the overall group, this human capital management software industry. And you can see that there's a discount for Paylocity's valuation by about 1 turn. We look at every indicator from the short interest to the valuation relative to its history, to the price trend relative to the benchmark, as well as the valuation versus the group. It's very clearly all bearish. Okay, so now let's summarize. We have 2 things. We have the earnings report itself. So this top bit over here, how does it compare to expectations? And then we have this bit over here, the guidance, how does that compare to expectations? So let's go through this just step by step. It can be very clear after this what the stock's going to do. Earnings per share, we have the earnings per share estimate. We have the actual $1.49. The difference is actually at 12%. It's a very strong beat. And we know that it's margin driven because sales slowed and they were under expectations, but cost reduction ensured that profits actually continued. So the guidance, the revenues were lowered at both the high end and the low end. That reflects the fact that sales are coming in lower than expected or slower than expected. The adjusted EBITDA or earnings guidance was lowered at the high end. So the range was tightened from the high end. But overall, since the low end was stable, that could indicate that profits should overall be stable. The estimate change based off that change in guidance, and we're looking at adjusted EBITDA, is actually a very, very small percentage decline, 0.3%. Now, coming into the earnings release, investors and traders were really bearish on the results, meaning that they expected negative results. So, what is the stock reaction from that? Well, one, we got an earnings beat, a very strong earnings beat, and we have a slight change to guidance, slightly negative. So it's conflicting, but the magnitude of the earnings beat was so much higher. So that indicates it's just slightly more positive. And because positioning was so bearish, meaning everyone expected poor results, with any positive sign, it's more likely that investors might turn positive. So that means the stock should most likely react positively. When positioning is very bearish, any positive sign is much more meaningful. And the opposite is true. If positioning is bullish, it means everyone expects great results. Any negative signs could cause investors to turn negative, change their positions. And that's why the stock becomes very sensitive to any small negative news. So I've written out some rough guidelines here to determine the stock reaction. Positioning is very bearish. So that would be an earnings beat, guidance lower, and it should be either neutral to slightly positive. So that's the expected stock reaction. So now if we jump back into our price chart just to look at what actually happened, the earnings release was in early February. You can see it's right around this point. And so the stock is actually slightly positive and has come down a little bit. So it's slightly positive to neutral. And so the stock reaction is coming in as expected based off this analysis. I hope this video has helped you understand stock reactions to earnings release. You can download this spreadsheet with this link below. You can use it to prepare for earnings releases. And once you can anticipate how a stock will move, it's just another toolbox in your investing toolkit to make money with stocks in the market. If you enjoyed it, please leave a comment or like or subscribe. It'll help YouTube give more of this type of content to you. And we pay attention to comments. So if you leave a comment, we'll answer your question and also make future videos that will help meet your needs. And hey, if you're active trading or investing in the markets, maybe you're looking for a new approach, maybe some more tools to help you make more money, maybe something that's more investing and less trading oriented, you can learn strategies that investors on Wall Street use to make money in stocks. So if you have an hour, why not check out a free workshop where we'll teach you the fundamental stock investing framework and the approach that you can use to pick stocks to get higher returns using fundamentals. And it also gives you direct access to a program where we train individuals like yourself that are interested in markets on the skills to make money with fundamental investing, things like reading financial statements or identifying quality companies, even using financial models and valuing companies. All this sorts of tools and methods to help you make money picking stocks based off the methods used by Wall Street professionals. And you also get direct access to people with Wall Street experience. So hopefully I'll see you there in the freight training or even better in our program. And thank you so much for watching, and I hope you have a great day.